Welcome back to Investing Talk Podcast.
Today we're looking at POIT Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. Okay, let's unpack this. We are looking at a company that is right at the edge of, well, a massive industry-altering transition.
Yeah, it really is.
And to give you the full picture today, we've pulled together their latest SEC filings, the quarterly earnings ledgers, institutional order flow data, and some very polarizing market commentary.
Very polarizing.
Right. The goal is to figure out exactly what is happening under the hood here, because if you follow the semiconductor or hardware space at all, you know that artificial intelligence is completely changing the physical infrastructure of data centers.
It's a complete overhaul. Copper wiring is out.
Exactly. It runs too hot, it takes up way too much power, and honestly, it just can't handle the bandwidth anymore.
Right, and photonics, which is using actual light to transfer data, is in. That is the new standard.
And POIT Technologies is stepping right into the center of that arena. Their stated mission is to become a major disruptor in AI photonics.
Which is a bold claim, but right now, they are actually attempting to cross the chasm from a research and development phase into early scalable commercialization.
So the big question we are trying to answer for you today is this an exploding AI connectivity play that you absolutely need to be paying attention to, or is it just another speculative gamble in a hyped-up sector?
That is exactly the right question to frame this entire analysis, because the stakes in the AI hardware space could not be higher right now. What's fascinating here is that we are watching a company attempt to bridge the gap between, brilliant patented engineering and actual scalable product sales.
Yeah, they aren't just selling a concept on a whiteboard anymore.
Exactly. They are pushing a proprietary platform meant to replace the traditional bulky hardware components we've seen from the legacy giants for decades.
But transitioning from R&D to commercialization is notoriously the most dangerous phase for any tech startup.
Oh, absolutely. It's often called the valley of death for hardware companies.
The valley of death.
Yeah, it is where the rubber meets the road. It's where a lot of promising companies just run out of cash before they can scale.
That is the perfect segue. Let's open up the ledger and look at the fundamentals, because the numbers here tell a really compelling, albeit complicated story of a company hitting a major inflection point.
They really do.
Let's look at their revenue trajectory first. In Q3 of 2025, their non-recurring engineering and product revenue hit $298,434.
Right.
Now, I'm looking at that number, and out of context, under $300,000 sounds incredibly tiny for a publicly traded tech company. I mean, why should an investor care about a number that small?
It does sound like a rounding error for a big tech firm, but if we connect this to the bigger picture, you have to look at the growth curve and what that revenue actually represents.
Okay.
That $298,434 is up from a mere $3,685 in Q3 of 2024.
Wow. Right.
And it's up from $268,469 in the previous quarter, Q2 of 2025. So the absolute dollar amount is small, but the percentage jump is massive.
This is the trajectory.
Exactly. What it signals to the market is that early commercialization progress is actually happening. They are no longer just doing science experiments. They are starting to move optical engine and light source products out the door and into the hands of real customers.
And here's where it gets really interesting for anyone projecting out into the next few years. The catalyst driving the forward-looking excitement isn't just that Q3 revenue blip. It's what management has secured for the immediate future.
The backlog.
Right. They've locked in 2 initial production orders from key customers that total over $5.6 million. That feels like the hard proof you want to see if you're looking for a scalable product sales ramp heading into 2026.
It is. It shows they're moving away from just doing non-recurring engineering services, which is basically just doing custom one-off R&D work for clients, and shifting into actually manufacturing and selling scalable products.
Yeah.
That $5.6 million figure is the anchor for the entire bull thesis right now. It shows tangible market validation. It proves that customers have tested the technology and are willing to write multi-million-dollar checks for it.
But we do need to look at the immediate reality of their execution.
Always.
Because I have to play the data checker here for a second. I was looking at the earnings report, and one number stopped me in my tracks. They actually missed their revenue consensus for the quarter.
They did.
They hit $0.30 million, but the street was expecting $0.55 million. Now, when you're a small company trying to prove you can scale, missing consensus expectations usually makes the market incredibly nervous.
It usually leads to a sell-off.
Right. However, there was a massive silver lining attached to that revenue miss that I want you to break down for us. They reported 100% gross margins on that revenue.
Yeah.
How is that physically possible for a company that makes physical hardware?
It's a great catch, and honestly, it's incredibly rare to see. Seeing 100% gross margins at this stage usually indicates that the revenue recognized in that specific quarter was heavily tied to licensing
Oh,
or non-recurring engineering milestones where the fixed costs of the R&D have already been completely accounted for in previous quarters.
so the money was already spent.
Exactly. There were no new cost of goods sold attached to that specific revenue realization.
Mhm.
What it tells you, broadly speaking, is that the core technology itself has the potential to be highly profitable.
That makes sense.
Once they get past the heavy lifting of establishing the manufacturing lines, the intellectual property they are selling has incredible margin potential.
Okay, speaking of the heavy lifting and the costs associated with it, let's group these numbers together and tell the story of their overall financial health.
Let's do it.
They are sitting on $107.8 million in total assets,
Right.
and that's backed by $13.5 million in cash reserves. Now, they are bringing through about $9.4 million a quarter. You don't need a calculator to see that the cash runway is getting a bit tight.
It is tight.
They're definitely spending money to make this transition happen.
They absolutely are. And that $13.5 million cash buffer is the most critical number on the balance sheet right now.
Definitely.
When a company is transitioning into commercialization, they burn cash. There is no way around it. They have to fund growth initiatives, secure supply chains, and market the product long before those big $5.6 million revenue checks actually clear and hit the bank account.
Right, there's a lag.
But the key takeaway for you as an investor is the trend line. Their net loss is actually narrowing.
Right, because if you look back a year to Q3 of 2024, they were losing $12.7 million a quarter.
Yep.
Even in Q2 of 2025, they lost $17.3 million. So dropping that net loss down to $9.4 million shows things are moving in the right direction. And I should mention the trailing 12-month net loss currently sits at $50.6 million.
Precisely. The cash burn is decreasing, driven by very targeted, disciplined R&D investments rather than wild, speculative spending. And their operating cash flow improved too. It went to negative $2.8 million from negative $5.5 million in Q3 of 2024.
So they are getting leaner.
Yes. And importantly, their debt-to-equity ratio is sitting at a very healthy 0.11.
That's reassuring.
They are not over-leveraged. They aren't drowning in toxic debt to fund this transition. Every spare dollar is being directed straight toward the revenue-generating production ramps.
So we've talked about the ledger, but what does this all mean for their actual product? Why are customers giving them $5.6 million in orders instead of going to established giants? Let's talk about their competitive moat.
It's crucial to understand this part.
It all comes down to what they call the POET optical interposer platform. I know what an interposer does in a general sense, but how does this specifically disrupt the legacy players like Intel or Broadcom?
This is the absolute heart of the company. To understand the moat, you have to understand how AI data centers are currently built.
Okay.
Traditional hardware solutions usually rely on what we call discrete components. Think of it like a sprawling, poorly planned city. You have a residential zone over here, a commercial zone way over there, and industrial parks miles away.
Sounds inefficient.
Extremely. To connect them, you have to build massive, inefficient highways. In the hardware world, that means buying separate lasers, modulators, and networking chips and manually wiring them all together.
Now that takes up space.
It takes up a ton of physical space, uses massive amounts of power, and costs a fortune to manufacture.
And space and power are the two most precious commodities in an AI data center right now.
Exactly. The legacy giants have traditionally relied on these sprawling, discrete component solutions. What POET's optical interposer does is act like a highly efficient vertical skyscraper.
Oh, I like that analogy.
It integrates all of those optical engines and light sources into a single, seamless platform specifically designed for AI networks. It offers superior efficiency, massively reduces power consumption, and is significantly cheaper to produce at scale.
And because this integrated technology is proprietary and fiercely IP protected, it creates incredibly high switching costs.
Yes, very high.
I like to think of it as a modern take on the classic razor and blades model. If a data center architect builds their new AI network around POET's highly specific optical interposer, they are locked into that ecosystem.
They are.
They aren't going to easily rip it all out and switch to a competitor 2 years later because it would require completely re-architecting their servers. Once you're in, you're in. And that protects POET's market share in a fiercely competitive, fast-growing industry.
That's spot on. Those repeat production orders we discussed earlier are early, tangible evidence that this high switching cost dynamic is already taking hold. Customers test the interposer, they measure the incredible power efficiency gains, and they lock themselves in.
Pivot to the charts to see how this is actually trading.
Yeah.
Because we have this incredible tech of $5.6 million backlog and narrowing losses. You'd think the stock would be on a nonstop rocket ride, but if you look at the technicals over the last few weeks, it's been a bit of a roller coaster.
It definitely has.
Just recently, the stock experienced a steep 13.2% drop.
Yes, and it's important to contextualize that drop for you. It was heavily tied to broader macroeconomic uncertainty.
Not the company itself.
Exactly. Whenever the broader market gets nervous about interest rates or inflation, speculative, growth-focused tech companies are always the first to take a hit. Capital flees to safety, and early-stage companies experience outsized volatility.
But what I found really telling wasn't the drop itself, it was the immediate recovery. We saw a significant intraday rebound, with the price fluctuating tightly between $7.265 and $7 a cent.
That's a key zone.
For you, as an investor watching the tape, this signals that psychological support is forming right around these levels. The market simply isn't letting it fall through the floor. Investors are actively digesting the news of those new production orders, and they are stepping in to buy the dip because they see the fundamental value of that backlog.
And the momentum has been shifting rapidly since that support level was tested. We saw reports of the stock trading significantly higher on a recent Tuesday morning.
Yeah, that Tuesday morning action was interesting.
It was accompanied by unusually high trading volume.
Volume is the key word there. I want to spend a second on that. Why does a sudden spike in volume matter so much more for a stock like this compared to, say, Apple or Microsoft?
It comes down to market mechanics and the concept of the float.
The available shares.
Right, the number of shares actually available for public trading. POET is generally undercovered by mainstream Wall Street analysts. They don't have a massive, highly liquid float being traded by thousands of institutions every single second of the day.
Okay, so it's a smaller pool.
Because of that undercovered status, any concentrated buying effort, say a mid-sized fund deciding to take a position, creates a significant supply and demand imbalance.
It moves the needle?
It amplifies the volatility and creates massive breakout potential. A small amount of volume can move the price dramatically.
Moving away from the math and the price action, let's gauge the market sentiment. Because the way the market feels about a stock, the narrative surrounding it, can often override the balance sheet in the short term.
Oh, 100%.
Right now, quantitative sentiment scoring paints a picture of a market that is really trying to make up its mind. It is a tug of war between neutral caution and aggressive bullish energy.
You can see this tension perfectly reflected in recent financial headlines.
Yeah, I saw a few of those.
On one hand, you have pieces titled, "Risky Bet on a Big Photonic Disruptor." Sentiment trackers score that as flat zero, completely neutral.
Just stating the facts.
Right. The author acknowledges the massive upside of disrupting the AI photonics space, but firmly highlights the execution risk of actually scaling the manufacturing.
But balancing that out, you have incredibly bullish pieces with titles like "Dilution Rhymes with Delusion."
That's quite a headline.
Right. And in that one, the author remains aggressively optimistic despite the obvious financial hurdles of being a small-cap tech firm.
But there is a major qualitative sentiment booster that we absolutely have to talk about. POET recently won the Lightwave Award for AI connectivity.
Yes, I wanted to bring this up.
And this isn't even their first time. They won it for the second year in a row.
Now, to the average retail investor, an industry award might sound like a meaningless PR stunt. Why does this matter?
In the highly technical, fiercely competitive world of optical engineering, peer validation is everything.
Everything.
This space is notorious for vaporware.
Oh yeah, companies promising the moon.
Companies claiming they have revolutionary tech that actually defies the laws of physics when you look closely. The Lightwave Award is judged by industry veterans. It tells the market, and more importantly, potential institutional investors, that the technology is real.
It's legitimate.
The experts have looked at the POET optical interposer and officially recognized it as a leading viable solution for AI connectivity.
Which brings us to the smart money. Who is actually buying this stock right now based on that validation? Recent SEC filings revealed a major institutional flow that caught a lot of people's attention.
Yes, they did.
The hedge fund MMC Cap International emerged as a significant shareholder. What does it mean when a fund like this steps in? Is this what we call cluster buying?
It's a fantastic indicator. When a hedge fund like MMCAP takes a significant publicly disclosed stake, It's a massive signal to the broader market. Hedge funds have the resources to do deep, exhaustive due diligence.
They aren't just guessing.
They aren't just reading press releases. They are tearing apart the underlying technology, interviewing industry experts, and auditing the order book. Their entry into the stock is a vote of confidence.
They see something the retail market might be missing.
It suggests they believe the transition from R&D to commercialization is actually going to succeed, and they want to be positioned before the broader market catches on.
So if you're holding this stock or thinking about opening a position, what is the catalyst calendar looking like over the next 3 months? The biggest date to circle is March 26, 2026.
Definitely circle that date.
That is their next earnings report. The consensus EPS is expected to come in at -$0.06. But honestly, I don't think the EPS is the main event here at all. What you need to watch for is the validation of that $5.6 million order ramp.
That's the real test.
Have they started recognizing that revenue? Is the backlog growing? Have there been any manufacturing delays?
You've hit the nail on the head. The narrative for the rest of the year will live or die based entirely on production updates.
Right.
Alongside the earnings report, you also need to keep an eye on industry events. They are going to be carrying that Lightwave Award momentum into major AI networking conferences, which is prime hunting ground for securing new contracts.
And we can't ignore the macro tailwinds pushing this entire sector forward. We're looking at a period of unprecedented AI infrastructure spending globally.
The spending is staggering.
The major tech companies are spending billions to upgrade their data centers. Coupled with a broader sector rotation into photonics and semiconductors amid expected interest rate cuts, the macroeconomic environment heavily favors any company providing critical, power-saving data center connectivity.
It's a perfect storm of positive macro factors.
It's not all green lights, though. Let's dig into the bear case. Because as much as the technology sounds revolutionary, and as great as the macro tailwinds are, investing in this exact phase of a company's life cycle is fraught with danger.
It certainly is.
I have to put on my skeptic hat here and point straight to the biggest risk on the board: dilution.
Is the single word every growth investor dreads.
Exactly.
Dilution feels from potential capital raises are a dark, heavy cloud over the stock, and it's the primary reason a lot of institutional money might still be sitting on the sidelines waiting for more proof of execution.
Right, because look at the valuation. This is where the math gets genuinely scary for a value investor. They have a price-to-sales ratio of 983.
It's high, very high.
That is a sky-high nosebleed valuation. Just to put that into perspective for you, a P/S ratio of 983 is like paying $1,000 today for a neighborhood lemonade stand that currently makes exactly $1 a year in sales.
That's a great way to picture it.
And you're doing it simply because you are absolutely convinced they are going to secure the beverage contract for the entire city next summer. You are paying a massive premium for an imagined future.
That is a perfect analogy. A P/S ratio approaching 1,000 means the market has already heavily, aggressively priced in future success.
Perfection is priced in.
The current stock price assumes that the $5.6 million backlog will be executed flawlessly with zero supply chain hiccups, and that it's just the tip of the iceberg for future orders.
And you have to remember, the AI photonics space is hyper-competitive.
Massive legacy players are pouring billions into trying to innovate their own integrated solutions. If POET experiences any delay in revenue scaling, or if data center adoption of their specific interposer slows down even slightly, the stock will get crushed under the weight of that massive valuation.
And if that scaling is delayed, they will continue to burn cash. We mentioned they have $13.5 million in reserves right now, burning about $9.4 million a quarter. If the revenue doesn't ramp up fast enough to cover that burn rate, management will have absolutely no choice but to issue more shares to raise capital just to keep the lights on.
And there's the dilution.
That instantly dilutes the value of every existing share, directly punishing the current investors who believed in them early.
That is the textbook worst-case scenario bear thesis. However, to maintain a balanced view, there are mitigating factors that we have to weigh against that dilution risk.
What are they?
Well, that $13.5 million in cash does provide a tangible, immediate runway. Furthermore, as we discussed earlier, their cash burn is actually improving quarter over quarter.
That's true. It did drop.
They are getting leaner as they scale. And the recent entry of a major hedge fund like MMCFP helps mitigate immediate distress. Institutional backing often provides a layer of stability and access to alternative capital that purely retail-driven stocks simply don't have.
They have options.
Assuming there are no catastrophic execution failures on the manufacturing floor, they have enough runway to fund the current order backlog.
Taking all of this together, it's time for the final verdict. We've looked at the tiny but rapidly growing revenue, the massive $5.6 million order catalyst, the brilliant but highly valued technology, the macro tailwinds, and the very real mathematical risks of dilution. Where did that leave us?
Based on a synthesis of the quantitative data and the qualitative market momentum, the final grade here is a bullish score of 8 out of 10.
An 8 out of 10.
Yes, the ultimate multi-year investment thesis is surprisingly clear. Poet Technologies is positioned as a legitimate, validated AI photonics disruptor. The transition from a tiny $298,434 base in Q3 to actively executing a multi-million-dollar order backlog marks a major, undeniable revenue inflection point for 2026.
It's happening now.
This isn't just a whiteboard idea anymore. The market is actively paying for the product.
I'll concede that the technology is undeniably impressive, and crossing that valley of death from R&D to commercial sales is a huge milestone. But I have to remind you as an investor that valuation is incredibly high. You're paying a steep premium today for growth that hasn't fully materialized yet.
That is the risk.
But when you combine the institutional backing from smart money, the narrowing financial losses, and that undeniable tech edge, which is protected by those high switching costs we talked about, it makes for a compelling multi-year hold. If you are betting on the exploding demand for AI connectivity, and you have the stomach to ride out the volatility of an early commercialization phase, this is a very serious contender for your portfolio.
It really is a classic risk-reward scenario in the hardware space. The transition from traditional copper wiring to integrated photonics isn't a passing fad. It is a physical thermodynamic necessity for the future of AI computing.
It has to happen.
PO has essentially built a proprietary toll bridge on that exact transition route. The only question remaining is how fast the data center traffic will scale to cross it.
And that leads to a final thought for you to chew on before we wrap up.
Yeah.
We've talked extensively today about POET's technology, their cash runway, and their immediate transition to sales. But think about the broader semiconductor ecosystem for a minute. If integrated photonics becomes the absolute baseline standard for every single new AI data center built over the next 5 years, how will the massive legacy players like Intel and Broadcom respond?
They won't just sit there.
Exactly. Will they spend billions trying to build competing integrated solutions from scratch, or will we see a wave of aggressive consolidation and acquisitions in this space? If you're holding a smaller disruptor with rock-solid proprietary IP and 100% gross margins on their licensing, you might not just be waiting for their quarterly revenue to slowly climb.
No, you might be holding a golden ticket.
You might be waiting for a massive buyout from a desperate legacy giant.
It's a very real, highly lucrative possibility in an industry that is moving this fast and requires this much capital.
As usual, before we sign off, subscribe, like, and comment to this video to support the show. Let us know in the comments if you think the AI hardware space is dangerously overvalued right now, or if we're just getting started on a multi-decade supercycle. Thanks for joining us.